What is burn rate? Burn rate refers to the rate at which a company or organization consumes its venture capital to finance operations before generating profits. It is measured in terms of monthly spending or cash outflows and is also known as net negative cash flow. Burn rate is a key metric for startups as it helps gauge how long they can sustain operations before running out of funds. High burn rates can be problematic, leading to shrinking runway, reduced investor interest, and the need for strategic adjustments. Burn rate is critical because it helps companies determine whether they are self-sustaining. Startups must strike a balance between spending and creating a sustainable business. By tracking burn rate, businesses can decide if they need to cut costs, increase revenue, or adjust their strategies. This metric also helps assess the need for additional fundraising or optimizing current expenditures to boost growth areas like marketing, product development, or R&D. Burn rate can be calculated in two ways: gross and net burn rate. Gross burn rate refers to the total monthly operating expenses, giving insight into how much money a company is spending each month. Net burn rate, on the other hand, factors in revenue and income against expenses, providing a clearer picture of the company's net financial depletion. To calculate burn rate, one divides the cash reserves by the monthly cash outflows to determine how long the company can operate before running out of funds. To control burn rate, startup founders must ensure that every expenditure contributes directly to the company's growth. This involves making calculated investments, hiring the right people at the right time, and avoiding unnecessary infrastructure costs by using co-working spaces. Startups should also focus on scaling gradually rather than expanding aggressively without ensuring demand. High burn rates have led to the failure of several startups, including Primary Data and Pearl Automation. Primary Data, a California-based data visualization startup, received significant funding but failed to generate sufficient sales. Despite attempts to pivot and acquire new companies, it was unable to compete in the market, leading investors to pull the plug. Similarly, Pearl Automation, a startup launched by former Apple engineers, developed an innovative product but struggled due to high pricing and strong competition, eventually leading to its closure. Both cases demonstrate the risks associated with high burn rates, where high expenses outpaced minimal revenues, resulting in unsustainable operations.